Hi everybody, welcome to my channel. If you have any trading experience in the stock market, I'm sure you must have come across people saying arbitrarily or loosely that the market is controlled or run by the option sellers. So in this episode, we will cover what option selling is and how the option sellers play their game when they can. So without further ado, let's go to the charts. Alright, here we're going to be talking about option sellers in the options market. So if you're a call seller, you will only enter the market if you have a bearish view. You are expecting the market to go downwards. Alright, because only at that time you would make a profit. Alright, okay. Now suppose the market goes sideways. An option seller, you wouldn't mind if the market goes sideways. Why? Because you have already sold your option, and on the other side there is a call buyer who has paid you the premium for it, and you have received or collected the premium which is in your pocket. So even if the market goes sideways, all right, as it nears the expiration date, is going to be beneficial for you as a call seller. So a call seller profits in the sideways market, so he wouldn't mind the market going sideways. Okay, now suppose there is a slightly bullish trend. The call seller wouldn't mind to have a slightly bullish trend in the market. Why? Because he has still, his call value is exhausted. Till then he still can be in a bit of profit. Alright, so remember this, you only enter the options market as a call seller if you have a basically a bearish view, and you wouldn't mind a sideways view, and also you wouldn't mind a slightly bullish, alright, where you can square it off quickly and earn a bit of profit. Alright, certainly as a call seller you wouldn't want to go against your view. If the market moves upwards, if it goes bullish, the market makes higher highs, higher lows, you lose your money. So remember that. These are the basic views which an option seller, a call seller has. Alright. Now the call seller sells call option, and the profit he makes is the premium which he has collected. Remember, when a call seller is selling an option, on the other side you have a call buyer. So when the call buyer is buying the option, he is paying a premium, and that premium is being received or collected by a call seller, and that is his basic profit. Remember that. And on the other side, the call seller has the potential to make unlimited loss. So the profit he earns is the premium he receives or collects from the call buyer, but he has the potential to make unlimited loss. Alright, now because of this factor of potential unlimited loss, the exchanges, alright, they have something called a margin. They want the call seller to have a certain amount in their trading account. What if that call seller loses a lot of money in the options market, right, and he runs away? To ensure that he doesn't, and the exchanges get the money from the call seller, they have something called a margin, which is pretty huge. For example, for a nifty, a one lot size, a call seller may have to have at least more than a lakh, say 1.3 or 1.5 lakh in his trading account. So that's a huge margin. Alright, but of course an option seller is not going to be in the market to pay such a huge margin. Alright, have such a huge margin in their account just to earn 2,000 or 3,000 or 5,000 rupees. Alright, he would be in the market to earn a bigger profit. Okay, so his aim is going to be high. So for that, exchanges have something called collateral. Okay, so instead of paying huge amount of cash, they have a system of collateral where the option seller can make use of their equities they have in their accounts, or the mutual funds they own, the bonds they have, or the government securities they have. Alright, so this is a good thing for an option seller. Instead of paying such huge margin, they can have these instruments as collateral, their equities, mutual funds, bonds, and government securities. Okay, now this is the prime reason, this margin, okay, Because of this is the prime reason and the prime difference between an option seller and a buyer, where you have very few, say 10 to 15% as option sellers, because very few can afford such a huge margin, understandably. Okay, and on the other side you have option buyers, which amount to say like 85 to 90%. Why? Because the margin is very less. All they have to pay is the premium. That's all they have to pay. Alright? Now, who can afford all this? Such a huge margin. Definitely not small time retailers, traders, and investors. It is these entities who are basically into option selling. The FIIs, DIIs, fund houses, and big investors and traders, high net worth investors and traders. Alright? Only they can afford such huge margin and different types of collaterals. Alright? Okay. Now when these entities, when they enter the stock market, they basically have two activities. One is to buy and sell shares, okay, and they trade in options and futures. Now here starts the games of the option sellers. Now what is their game? Now through the reports and researches which they receive from different parts of the world, alright, and their research and reports are top notch, unparalleled, okay, and through those reports and researches, if they come to know that it's going to be a bullish trend in the market, remember, a call seller is entering the market with a bearish view. He wants the market to go downwards, but through the reports and researches, all right, they think the market is going to go upwards against their view. What they do? They start selling shares by the tons. All right, they start selling their shares left, right, and center. And what happens because of that? The Nifty goes down. All right, favoring the view of the option seller, the call option seller. Okay, now what happens when they start selling the shares? When the market goes down, and the small time retailers, investors, and traders, they start panicking, and they too start selling their shares, taking the Nifty further down, favoring the view of the call sellers. Alright, I hope you understood this. These institutions, they enter the options market with the view that it's going to be bearish, the market is going to go down, and they're going to make money through selling call options. And when they find some reason that it's going to go against their view, they, for example, they think the market is going to go upwards, they start selling shares. The small time retailers and investors, they too follow suit, they too start selling shares. Market goes down, which favors the call sellers. Alright, and this is how they make profit. Okay, alright, now what are the profit probabilities of a call option seller? If the market is bearish, they make profit. If the market goes sideways, as I explained earlier, they make profit. And if the market goes slightly bullish, still they make money till the call value is exhausted. Alright, and in one scenario that is totally against their view, if the market goes upwards, okay, which is against their view, they make a loss. So 3 out of 4 times they make money, as opposed to a option buyer, they make 1 out of 3 times money. So the probability for option seller to make money is 3 out of 4 times. I hope you like this video. Thank you for listening. See you in the next video. Bye bye. Hit the like button, subscribe if you haven't already, and as usual, have a great day.